Alaska Air just proved an airline can sell plenty of seats and still have the quarter hijacked by fuel, storms, and geopolitics.
Yeah, and honestly, that's why this one's interesting. The business wasn't falling apart. The environment kind of was.
This is Earnings Unscripted, and on 2026, April 21, we're talking Alaska Air Group, ticker ALK, the airline group behind Alaska and Hawaiian, first quarter 2026. They did $3.3 billion in revenue, adjusted EPS of negative 1.68, and an operating loss of $279 million.
Which is the paradox, right? Revenue was up about 5% year over year, but the operating loss worsened from $197 million.
In quarter over quarter, we don't actually get a clean standalone Q4 P&L comp in the filing, so year over year is the honest lens here.
And the human version is, people still wanted to fly. Premium revenue rose 8%, managed corporate travel jumped 19%, which is not what you'd expect if demand had just rolled over.
Exactly. Then Mother Nature and the news cycle stepped in. March rainfall in Hawaii hit as much as 3,000% of normal, which sounds fake. And civil unrest in Puerto Vallarta hit another leisure market. Management says those shocks erased nearly a point of unit revenue.
Also, quick legal umbrella, this is not financial advice, just our opinions, lightly caffeinated, and definitely not your broker. So wait, if demand held up better than the headline loss suggests, why did the stock react like somebody pulled a fire alarm?
Because this was less a neat beat or miss story and more really the visibility story. We don't have a clean consensus sheet in front of us, but the tape made the point. After a brutal quarter already, the stock dropped another 7.7% on earnings, falling from a 43.54 close toward 40.87 in the immediate after-hours move, and the call didn't meaningfully reverse it.
Right, because we're suspending full-year guidance tends to do that.
Exactly. And the reason is oddly specific. Fuel sourced from Singapore, historically their cheapest bucket, suddenly became their expensive bucket after local refining margins spiked 400%. That hit roughly 20% of total fuel consumption. It's such a physical, real-world miss, not vibes. Jet fuel logistics.
I hate that I enjoy that story. It's terrible for them, but it's also wonderfully concrete, an earnings stumble caused by geography.
Yes, and that's why I'm not fully bearish on the core business. Premium held up, corporate held up. They even took debt down to $5.32 billion from $5.56 billion. But cash also fell to $1.795 billion. CapEx was $338 million, and now buybacks are paused. So management is basically saying, the engine is fine, please ignore the turbulence.
And the CEO more or less did say that, right? Absent fuel, they're firing on all cylinders, which is bold, maybe a little too bold.
That's the tension. Maybe he's right underneath the shock, but they're also reducing visibility just when investors want more of it. Segment reporting is being collapsed, so teasing apart Alaska versus Hawaiian gets harder at exactly the moment people want to see who is carrying what.
So the simple version is resilient demand, ugly cost shock, guidance gone, and less transparency right when the market's already jumpy.
That's it. And look, the real question now is how much of this was a freak quarter and how much is the new reality for a Pacific-heavy airline trying to digest Hawaiian?
All right, let's get into the fuel mess and the vanishing visibility because that's where this quarter actually starts talking.
Yeah, and the fuel part gets weirder the deeper you go. This wasn't just oil went up. The CFO said, quote, fuel sourced from Singapore, which historically has been consistently the lowest cost portion of our supply, became the most expensive, impacting roughly 20% of our total consumption. That's a supply chain shock wearing a fuel costume.
Right. So not some abstract commodity chart. It's literally where the molecules came from.
Precisely. Alaska has the specific heavy footprint, then they add Hawaiian, and geography matters twice. West Coast refining is already awkward for them. Singapore had been the cheap workaround, then local refining margins spike 400%. Their cheapest lane flips into their worst one almost overnight.
Which is kind of brutal. The route map that made the deal exciting is also the thing that leaves them exposed when the Pacific decides to get theatrical.
That's basically it. And what I liked, actually, is management didn't hide behind finance speak. They were talking about physically tankering fuel into Seattle. That's old-school airline operations. Move fuel differently, use the network differently, try to break the bad pricing loop.
Wait, explain tankering like I'm not secretly moonlighting in airline ops.
Sure. Instead of buying as much fuel at the expensive airport, you carry more from somewhere cheaper, within safety and weight limits. Sounds tiny. It isn't. You're using the aircraft itself as part of the supply chain.
So the plane becomes a flying Costco run?
Yes, a highly regulated Costco run. But the serious point is this quarter reminded you airlines are still very physical businesses. People hear premium cabins, loyalty, brand. Underneath, it's refinery bottlenecks, weather, labor, airport logistics. Very concrete, very annoying, very expensive.
Okay, but if it's that concrete, maybe investors should be a little more forgiving. 3,000% rainfall in Hawaii that sounds like a typo. Civil unrest in Puerto Vallarta is not management error. Singapore blowing up is not management error.
Fair. But investors aren't only reacting to the shock. They're reacting to the fact that the dashboard is getting harder to read right when the business gets more complex. And this is where I get a bit prickly.
There he is.
Starting in 2026, they collapse Alaska, Hawaiian, and regional into one passenger air transportation segment. So the exact moment everyone wants to know whether Hawaiian is healing, lagging, cross-subsidizing, whatever, that separate view disappears. Then CASMEX, their favorite unit cost metric, now excludes performance-based pay in 2026, which makes future cost progress look cleaner than a like-for-like comparison would.
So the instruments aren't gone, they're just tinted?
Nicely put. And they also changed the debt-to-capitalization formula to exclude the current portion of operating and finance lease liabilities. Prior periods are recast, which is allowed, but it's another little optical improvement during a rough patch.
I can feel my sympathy for management colliding with my allergy to moving goalposts.
Same. I don't think this proves they're hiding disaster. I do think they're sanding down the external story while the integration is still unfinished.
And that's why the upbeat tone lands a bit oddly, because on the call they sounded almost serene.
Some of that confidence may actually be earned. The single passenger service system cutover is a real milestone. The CFO said, "We are now on the eve of our single passenger service system cutover, a peak integration milestone that, once complete, puts much of the integration friction firmly in the rearview mirror." On the morning of the call, they'd already moved the last Hawaiian reservations over. And remember, last year's IT outages cost them about $50 million pre-tax. So getting a migration like that done cleanly matters.
Which sounds unglamorous until your airline app eats your booking and your soul leaves your body.
Exactly. And there's another underappreciated lever here, the Bank of America extension. Management said moving Atmos to a single issuer brings $1 billion of incremental cash remuneration through 2030. That's about half a point of margin this year and a full point next year. For an airline, that's huge. It means some earnings power is coming from the wallet, not just the wing.
That's such a strange modern airline sentence, but I get it. While fuel is punching them in the face, the loyalty machine is quietly stuffing cash in the glove box.
Yes, that's the elegant version. Which is why this quarter is genuinely hard to read. The reported loss is ugly. The underlying commercial demand doesn't look broken. Integration milestones seem real. Loyalty economics are improving, but the pieces investors need in order to verify all that are getting less visible at the same time management is asking for trust.
And trust is expensive when you just yanked full year guidance and said, more or less, please judge us later.
That's it. Plus, they still won't quantify the labor harmonization from joint CBAs. They've acknowledged Hawaiian employees coming up toward Alaska pay scales, but there's no clean cost timeline attached. So you have hidden positives, loyalty and tech integration, and also partially hidden costs, labor and reporting simplification.
So this is less bad airline quarter and more how much faith do you place in management's internal map when the external scoreboard gets blurrier?
I think that's the real question. If fuel normalizes, they could look a lot better very quickly. If fuel stays ugly and the reporting stays streamlined, skepticism sticks, because nobody likes grading homework with half the pages missing.
Yeah, so where does that leave them really heading into next quarter?
It leaves them in prove-it mode. For Q2, they're basically saying capacity grows only about 1%. Unit revenue could be high single digits, maybe 10%, but unit costs are still another 1.5 above Q1. And with fuel around $4.50 a gallon, they still see roughly $1 of adjusted loss per share.
Which is such a strange setup. Commercially, we're okay. Financially, please avert your eyes.
Pretty much. And that's why suspending the full-year guide matters more to me than the Q2 loss itself. A bad airline quarter happens. Losing visibility is what shrinks the market's patience.
Right, because investors can forgive turbulence. They really hate flying blind.
Yes. If premium, corporate, and the loyalty economics keep compounding, this can recover fast. If labor harmonization starts biting and fuel stays ugly, then the story stops being temporary shock and starts looking more structural.
So this is the identity test, really. Are they becoming a sturdier Pacific network with a real credit card engine, or are they still just an airline with nicer branding and more ways to get sideswiped?
Fair. I actually think the buyback pause helps credibility. They spent $203 million in Q1, then hit pause until conditions stabilize. That reads prudent to me, not panicked.
I was going to say cautious, actually no, disciplined, which is not a word I hand airlines very often.
Same. And the CCO had that line about consumers still wanting to go out and experience the world when they have discretionary income. Maybe. But next quarter is less about wanderlust and more about execution.
Yeah. Clean ops after the system's cut over, no nasty labor surprises, and some proof that the wallet business can cushion the wing business.
That's the bet. Management can sound convicted all at once. Now the market wants receipts.
Finance in one sentence. All right, I think that's a good place to leave it. Thanks for listening, everyone.
Thanks all. Talk soon.
If you want these earnings chats to just show up in your feed, you can follow the show. And small aside, this episode was made with AI tools from the company's earnings release and call transcript, then shaped into this conversation. So if there's a ticker you want us to dig into, or just a note for us, send it to earningsunscripted@datamadness.ca. All right, take care.
See you next time.